Imagine you're sitting across from a friend, perhaps over coffee, and the conversation shifts to something that might seem a bit dry at first glance: finance. But hold on, we're diving into a topic that's not just for accountants or Wall Street types. It's something that affects businesses in ways that could impact your investment, your job, or even the products you buy. Today, we're talking about additional paid-in capital, or APIC for short. Sounds technical, right? But trust me, it's crucial for understanding a company's financial health and growth potential. So, what exactly is additional paid-in capital? At its core, APIC is the money that investors pay for a company's stock above its par value. Think of par value as the nominal price of a share, often set at a low amount, like $1. If a company sells its shares for $5, the extra $4 is considered additional paid-in capital. It's like a bonus for the company, a financial boost that can be used in various ways. This capital is essential for funding growth initiatives, expanding operations, or even just keeping the lights on. Let's break this down further. Why does APIC matter? Well, it provides a way for companies to raise capital without taking on debt. Imagine a startup looking to develop a new product. Instead of borrowing money and incurring interest payments, they can issue shares and raise funds through APIC. This not only gives them financial flexibility, but also reduces their financial risk. Investors who buy into this capital are typically optimistic about the company's future, creating a mutually beneficial relationship. Now, where did the term APIC come from? It's a bit of a history lesson. Back in the day, when companies started issuing stocks, the par value was often set low to make shares affordable. As companies grew and their stock value increased, investors were willing to pay more than the par value. This excess payment became known as paid-in capital in excess of par, which eventually got shortened to additional paid-in capital. It's a term with roots that reflect the evolution of corporate finance. From an accounting perspective, APIC plays a significant role. It's recorded on the balance sheet, showing up as a separate line item under stockholders' equity. This is where it gets interesting. APIC is a key component of a company's equity. Financial analysts often look at it to gauge a company's overall financial health. A healthy amount of a PIC can indicate that a company is successfully raising capital and expanding its operations. Let's look at some real-world examples to make this clearer. Say company XYZ issues 10,000 shares with a par value of $1 at an issue price of $5. The additional paid-in capital from this transaction would be calculated as follows: x 10,000, which equals $40,000. That's $40,000 that company XYZ can use to invest in new projects or pay off debts. Now, consider a startup, company ABC, that issues 50,000 shares at $10 each. The additional paid-in capital here would be a whopping $450,000. This is significant for a startup, as it means they can fund product development, hire new talent, and expand their operations without the burden of debt. It's a lifeline for many new businesses trying to establish themselves. Now, what about established companies? Company XYZ decides to issue 100,000 shares at $20 each. The additional paid-in capital here would be $1.9 million. That's a substantial amount that could be used to pay off existing debt or invest in new technology. The possibilities are endless, and this is where APIC can be a game changer for a company's growth trajectory. But what's the difference between APIC and retained earnings? Great question. While APIC represents the money raised from issuing shares, retained earnings refer to the profits a company keeps after paying dividends to shareholders. Retained earnings can accumulate over time and are often used for reinvestment in the business. Both are vital for a company's financial health, but they come from different sources. Let's talk about the benefits of raising capital through APIC. First off, there are no interest or repayment obligations. Unlike loans, which come with strings attached, APIC allows companies to raise funds without the pressure of paying back investors. This can be particularly advantageous for companies that are not yet profitable. Another benefit: no dilution of control. When a company raises capital through APIC, existing shareholders don't lose their ownership stake. This is crucial for founders and key stakeholders who want to maintain control over the company's direction. Raising capital through APIC can also improve financial ratios, making a company more attractive to lenders and investors. A strong APIC position can signal stability and financial security, which is always a good thing in the eyes of potential investors. But it's not all rainbows and butterflies. There are risks associated with relying heavily on APIC. For one, issuing more shares can dilute the ownership of existing shareholders. This means that each share represents a smaller percentage of the company, which can affect control and earnings per share. Additionally, if a company's stock price falls after an APIC offering, it can create pressure to improve financial performance. Investors expect growth, and if that doesn't happen, it can lead to disappointment and a decline in stock value. Companies need to be strategic about how they approach raising capital through APIC. Now, what happens to APIC when a company is sold? This is where it gets interesting. If a company is sold for a profit, the additional paid-in capital can be distributed to shareholders. However, if the acquiring company retains the APIC, it can use those funds for its strategic initiatives. It's all about how the deal is structured and what the acquiring company plans to do with the assets. Let's not forget about the factors that can affect APIC. An initial public offering is a significant event that can lead to a substantial increase in APIC. The price at which shares are sold, the demand for the stock, and the number of shares issued all play a role in determining how much capital is raised. Stock issuances, employee stock options, and even acquisitions can also impact APIC. Companies need to be strategic about how they manage their stock and capital structure to ensure they're optimizing their additional paid-in capital over time. So, how can businesses increase their APIC? They can issue new shares, offer convertible securities, or even conduct rights offerings, allowing existing shareholders to buy additional shares at a discount. Each of these strategies has its pros and cons, and companies need to weigh their options carefully. In conclusion, additional paid-in capital is more than just a line item on a balance sheet. It's a vital component of a company's financial strategy. It reflects the confidence investors have in a company's future and provides the necessary funds for growth and expansion. Whether you're an investor, a business owner, or just someone interested in finance, understanding APIC is crucial for making informed decisions. As we navigate the world of finance, let's remember that behind the numbers are real companies, real people, and real opportunities for growth. So, the next time you hear the term additional paid-in capital, you'll know it's not just jargon, it's a key player in the financial health of businesses everywhere.